Ultimately, today's discussion is really on just a recap of what happened in 2017, and then also just some things that you can do for 2018, so this year moving forward. So today is really all about the market, how we performed last year, how some things to expect this year. So I'll be giving you a pretty in-depth report, and I also break down some of the few things that I believe is going to happen in 2018. So ultimately in 2017, it was very eventful, to say the very least. Our president and Congress tried without success to repeal the Affordable Care Act, also known as Obamacare. Unfortunately, that just did not go through. However, the new tax law essentially eliminated the individual health insurance mandate, which is a part of Obamacare. So overall, the health insurance penalty is pretty much gone. So if you don't have health insurance after next year or after this year ends, pretty much you're off the hook as far as the penalty. And so the U.S. economy started pretty slow during the year, but ultimately picked up some steam as the year went by. So 10 years, so there's a statistic out there that's saying that the financial crisis has officially come to an end in 2017. So the last crisis that we had, from the 08-09 days, that's officially over 10 years after. So in 2007 is really when it started. So 10 years after that, we've officially ended the crisis. And then ultimately GDP, so gross domestic product, expanded to an annual rate of 3.2% in the third quarter. Unemployment fell from 4.7% to 4.1%, with 2 million jobs being added ultimately in 2017, or as of November of 2017. And then the Federal Reserve, so if the economy is doing well, they usually increase interest rates, which is what they did 3 times last year. So they increased interest rates by 75 basis points, or 0.75%. And so usually when they increase interest rates, it means that the economy is doing well. It means that there's something that's actually going right in the economy. And so the way I view it is that I don't believe there's a recession or anything like that coming anytime soon. We had very strong numbers in 2017. And so with 2018, we're already hitting the ground running heavy. The stock market, the first day that the market opened, which is January 2nd, I mean, it was pretty nice, let's just say that. So overall, we're still doing good. We're still carrying the momentum from 2017 into 2018. I don't expect a recession in 2017. There will be a ton of, in 2018, there will be a ton of signs that would point out to a recession. So overall, I think we're in very good shape in 2018. I think that if you have not invested, or if you're not an investor, or if you don't have enough money invested, I highly encourage you to become an investor in 2018. So this year, please go ahead, invest, put your money where the market is a saying that goes. So pretty much, overall, the market has done really well this year. I'll share some statistics and just some things to also look forward to even moving forward. And so some other things that happened is that, so the stock market reached several highs, historic highs in 2017. Consumer income rose and purchases increased, and inflation remained stubbornly below 2%. So somehow inflation is not where we expected it to be. So inflation expected to be around 3%, but now it's slightly below 2%. And then business investment expanded in 2017 and is also continuously expected to expand. So especially with the new tax law that came out, more businesses are expected to bring jobs to the U.S. and to ultimately further stabilize the economy, create more jobs in this economy, because they now have more tax breaks to do so. And so we should be seeing a steady increase, or a very large increase, and how many jobs are being produced each month. And that's really a number to pay attention to. It tells us how well the economy is doing. And so the year ended really well. I mean, the the stock market was really good. Every other market, I mean, pretty much every market that I'm about to talk about today did fairly well. And then, of course, we ended the year with a big tax reform, which has caused a lot of headaches among people, among accountants, among everybody pretty much, on what to do exactly. So that's something that happened last year, at the end of last year, and it's effect as we speak right now. So overall, in the market, the Dow Jones closed the year at 25%. NASDAQ closed at 28%. S&P 500 closed at 19%. Russell 2000, 13%. Global Dow of 22%. And once again, the Federal Reserve increased interest rates by 75 basis points, also known as 0.75% or 0.75%. And that ultimately that means that it costs a little bit more money to borrow money, because the Federal Reserve, whatever they're lending out to the banks, they're lending it out to them at a slightly higher rate. Interest rates are still not high compared to what it's been in the past. Back then, you could put money in a CD and get 13%. Those days are long gone. You'll be lucky to get 1% or 2% in the CD nowadays. So interest rates are still pretty low, at least comparatively to history. And then 10-year treasuries, probably one of the few things that are down right now. Last year they were down 3 basis points, which is not that much at all. So overall, let's talk about a few markets a little bit more in depth. So the stock market saw several benchmark indexes reach record highs throughout 2017. Market growth occurred despite several events that could have been challenging, such as the Russian probe. You had a big scandal that went on. The Federal Reserve increasing interest rates. And then you had some hurricanes that went on that might have damaged some things. You had some domestic violence, sexual abuse, all those crazy things going on in the media that all has an effect on the market. And then potential struggle over the debt ceiling. So in the U.S. is trillions in debt right now. So that's a big problem that we have. But overall, we still did really well. Strong corporate profits and then a general upswing in the domestic and global economic growth helped push equities to new highs. So the Dow Jones, for example, closed 2017 at 24,719. That's the highest it has ever been in history. So we really crushed some records. We really broke some records last year. I remember when Dow was at 21,000 and people were like, is this really going to happen? Well, they closed at almost 25,000, which is a huge number, historic. This is definitely record-breaking, and it means that if you did not invest in 2017, you might have lost out on quite a lot of money. And so overall, we did really well, even though we had some negatives going on. We had some scandals, we had some hurricanes, some increase in interest rates and different things like that. We still did really well. And I believe that we're going to continue doing well, especially with tax rates being lowered, especially for corporations. So now the highest tax rate for corporations is 21%, meaning that more money will be going to the bottom line or into the profit margin. And so more money can be distributed to shareholders, to employees, to hire more people. So overall, that's going to stabilize or further stabilize the profits of these companies. So I would expect that Q1, so in March, say around March or so, that corporate profits are going to be pretty high because of these new things that are being put in place. And then remember, we have technological advances. We have the medical, they got some medical medicinal marijuana, and all those different things are increasing. The state of California actually just sold, or they're allowed to sell recreational marijuana now as of January 1st of 2018. So overall, that's something really big. That's an industry that's fast and growing. I personally own companies in that industry, and they've been doing pretty well. So that's something to watch out for. And so overall, we have a lot of positives going on in the markets in the world right now. Although we do have a few negatives as well, of course. But overall, the market in general is doing pretty well. We have a lot of great things going for us. I think 2018 is going to be a fabulous year. I believe is going to be better than 2017, even though we've seen historic highs in the stock market. Dow Jones went up 25%. I think we can go up to 30% this year. So if you haven't invested, if you're not an investor, I highly recommend that you buy some stocks, you get some coins, you do something investment related. It doesn't have to be big. I start off all investments with $100. You can buy a stock with as little as $1, to be honest. So it's something that we must do. I mean, you won't see that much of an impact or a difference with $1 being invested versus, let's say, $10,000 or $1,000. But it can make an impact. Remember, Bitcoin, if you invested in Bitcoin just $100 7 years ago, you would have had, let's say, over $40 million today had you just put $100 away towards Bitcoin. Money that you could have just left sitting, just waiting pretty much. I mean, I have clients to this day who are millionaires because of Bitcoin, and the thing just keeps going up. So overall, if you and remember, we have so many options as far as investments. We have stocks, bonds, ETFs, Forex. We have cryptocurrencies now. We have real estate. We have car rentals. We have so many different Airbnb. We have so many different things that we can invest in. So my biggest point for today is that just reading you all of these different, and these are facts, by the way. These are real, actual numbers that came out. Reading you all of these things, it should encourage you, or I would hope that it encourages you to invest some money in 2018. It doesn't have to be big. It can be something small. It can be on a monthly basis. It can be on a weekly basis. It can be a lump sum. Maybe you got a bonus and you need to invest some of that money. I personally like to invest through retirement accounts, so IRAs, 401ks, different things like that. Your IRA or 401k, a lot of people won't tell you this, but your IRA or 401k can own pretty much anything. For example, my IRA and my health savings account, they each own a piece, or they each have an LLC that owns real estate. So my IRA and my health savings account, or HSA, is an owner of an LLC, a limited liability company, which buys real estate. So that's something to keep in mind, is that if you're not an investor, if you don't invest, it's going to be a problem ultimately, because you can't miss out on 25% return. And this is average. This is not even the highest return. This is pretty much the average return of these indexes. So this isn't even the high side. This is just the average of it. And so my biggest recommendation is you absolutely go out, get an account, open a Robinhood, a TD Ameritrade, a Coinbase, a Lending Club, something out there that you can invest. Now, Lending Club did not do too well last year, so I'm kind of hesitant when I recommend that. But ultimately, that's not even tied to the market. Lending Club is in no way, shape, or form tied to the market. That's just you lending out money to people. But when we talk about market, we talk about cryptocurrency, we talk about real estate, we talk about not car rentals, but we talk about bonds and different things like that. Overall, they're all doing, for the most part, pretty well. Unfortunately, 10-year treasuries aren't doing too well, because if you think about it, how much they're giving you such low returns, who would want to invest in them anyway? And so that's something to keep in mind. But overall, other things that happened, so there was some market volatility, but it was pretty low last year. And so there were very few weeks where we had negative returns. Maybe out of 5 weeks out of the 52-week year that we had last year, maybe 5 of them were negative. So we had very strong numbers last year. So as I was saying, the Dow went up over 25%, S&P over 19%, the small caps of the Russell 2000 grew over 19%, and then we have NASDAQ, which was almost 30%, which I think it's going to exceed that amount or that number this year. So we had very strong, and other indexes, the Stocks Europe 600, about 10%. So not even just in the U.S., but globally, we had a pretty good year. And then bonds. So bonds really didn't do as hot as stocks, of course. So as stock prices soared for much of 2017 and interest rates moved incrementally higher, the demand for long-term bonds were marginal. Yields on 10-year treasuries were volatile for the second straight year, ultimately falling below the 2016 year-end totals. So the yield on 10-year treasuries actually went lower than 2016, something you don't see across all of these asset classes that we have. And then the yield on the benchmark 10-year treasuries closed at 2.41%, which is down 3 basis points from 2.44% of 2016. And so during the early part of the year, bond prices rose as yields sunk below 2.3%. However, as investors saw a strengthening economy and rising interest rates, a period of bond sales occurred, which peaked during the last quarter, ultimately pushing yields closer to last year's final value. So what that means is that ultimately bonds, they just didn't do too well compared to equities, real estate, currencies, all those different asset classes. Bonds probably performed the worst out of all of them. And then we have oil. So oil went up pretty big last year. So it took almost the entire year, but oil prices began to surge at the end of 2017, reaching over $60 per barrel. So oil prices dipped below $45 per barrel, eventually went around $51 per barrel for much of the early part. But then the U.S. oil prices soared nearly 27% since September as OPEC limited supplies while demand increased. So the same principle here, and that's same with across a lot of investments. It's all about supply and demand. The reason why Bitcoin is so high right now is because a lot of people demand it, and there's very low supply. There's actually an infinite amount of, or not an infinite, there's a limited amount of Bitcoins that are out there right now with the new set of coins set to release pretty soon. So overall, there's a limit on how many coins there are right now, and just as with oil, when you have higher demand, lower supply, you're going to see prices increase, and then it's vice versa. And so what we've seen was that limited supplies and higher demand, which boost the prices up. And then retail regular gasoline prices closed the year around $2.47 per gallon on December 25th, about 0.16 cents more than a year ago. So gas prices have gone up overall. And then let's talk about interest rates. So as stated before, the FOMC, or the Federal Open Market Committee, raised interest rates 3 times during 2017. The first rate happened in March, followed by a rate increase in June, and then another in December. And so we did not have one in September for whatever reason. And then each rate increase was 25 basis points, so a quarter of a percent, or 0.25%, for a total rate increase of 75 basis points, or 0.75%, or 3/4 of a percentage. So following each rate increase, the committee expressed the expectation that the labor market would remain strong and the economy would continue to expand, while noting that inflation has not risen as quickly as they anticipated. So the Federal Reserve, for example, let's say they expected inflation to go up 3%, or inflation to be 3%, but it actually ended up being 2%. And so they sort of overestimated their inflation figures, which doesn't really mean too much on a high level, but it does impact how often they're going to increase interest rates, which is probably why they did it 3 times instead of 4 times. They were expected to do it 4 times, but probably since inflation was lower than expected, they only did it 3 times because they always want to be cautious. Some people say the Federal Reserve was who caused the last recession. So they're extremely cautious. And then, of course, the last Fed chair, Janet Yellen, retired last year, and we have a new Federal Reserve chair that's in there right now, manning the show. So overall, we had interest rate increases. And so in 2018, the committee said, the FOMC, they said they forecast about 25 basis point interest rate increases in 2018, which is exactly what we had in 2017. So you should see interest rates increase. So if you're looking to get a mortgage, if you're looking to get a home, it's probably best to do that now when interest rates are still lower. Because interest rates, as the economy is doing well, as stock prices keep going up, you'll see that interest rates will just keep going up. And so that means it's going to be harder, or it's going to cost more money to borrow money. So for people like me who like to borrow a lot of money, I'm going to be hurt because, but ultimately when I borrow the money, I'm investing it back into the market. So it's like if the market is going up 25%, interest rates are only going up 1% or 0.75% throughout the year. That's a win. That's a very large spread. That's about a 24% spread, 24% gain that I would have if I go out and borrow some money. I mean, of course, interest rates are, ultimately the actual interest rate is going to be higher than, less than 1%. But just to put some things in perspective comparatively, if something has increased 25%, the market has increased 25%, interest rates have only increased 75 basis points. Had you invested, so for every dollar that you invest, you would make 24 times, pretty much 24 times the money. So I like those odds pretty well. Just something to keep in mind, as you're an investor, as anything like that. As these markets keep going up, when you borrow money, which is exactly what I actually did last year. I actually borrowed some money, invested it, and pretty much tripled it or quadrupled it at even some point. So that's what I like to do sometimes. I like to borrow money and make more money from it because interest rates are still pretty low right now. You, of course, you have to know what you're doing. You have to be a savvy investor. You have to, you don't have to be Warren Buffett to know this stuff. You don't have to be Warren Buffett to know that the market went up 25% last year. That's just you going on a computer, clicking Google, searching Dow Jones increase in 2017. You'll see 25% right then and there. So overall, once you know these things and once you become more comfortable investing, then you can take advantage of certain things like borrow money to make more money, or leverage, they call it. Same thing I do in real estate. Same thing I do in cryptocurrencies. Same thing I do everywhere is you borrow the money and you make more money from it. You have to know what you're doing, though. In the beginning, you want to start with your own money. You risk it a little bit. Or I don't even call it risk. I call it, making an investment. Because to me, risk is only stuff that you don't know. And something is risky when you don't know much about it. If you know all about something, I don't think it's that risky. If you're an expert, if you follow cryptocurrencies since the day it was born, and you followed the charts, you know exactly. I mean, if you know how every single event happened and what trends happen after every single downturn or anything like that, if you're able to do that, then how can investing in cryptocurrency be risky? So to me, anything in life that's risky is something you don't know. There is risk involved in investing. There is always going to be risk. But something is risky if you don't know what you're doing. So that's just my opinion. So some people ask me, hey, should I invest in cryptocurrency? I see that it's risky. Should I buy stocks? I see that it's risky. Well, should you drive a car? Because it's risky. If that was the case, then nobody would be out on the streets. We would just all be taking buses. As a matter of fact, nobody would be driving, period, because we would all think it's risky to drive. It's the same thing with investing. You learn, you go on, you learn how to drive, or you learn how to invest. You practice, you go to driver school, you do whatever it takes to get your license, and then over time, you're going to become a better driver. Your accident rates are going to be lower, hopefully, as you gain more experience driving. Same thing with the stock market. Same thing with real estate. Same thing with cryptocurrency. Same thing with bonds. Same thing with anything in life. If you know how to do it well, then there's really no risk because you know how to do it. And then if something like a recession is coming, the last recession showed so many red flags. I mean, so many red flags. But the problem with it is that people are reactive instead of proactive. So if you were proactive, you could have easily seen that a recession was coming 3 months before it happened. So I was talking to an investor the other day. He said what he did was he just pulled out his money before the recession happened because he's seen so many red flags. I mean, when you see people going scandals and bankruptcies being, even the slightest of being announced to the public, that gives you signs. For example, if Apple was to announce that, hey, we see the sign of going bankrupt in the next few months, I would be very concerned. Of course, that's not really going to happen, so we don't have much to worry about. And then overall, so some other things in here. So the dollar actually dropped for the very first time in the past 5 years. So the dollar, this marks the first annual decline in the value of the dollar in 5 years. So this is a little scary. And I believe cryptocurrency probably has a lot to do with this. But overall, the dollar went down. So it's, even though the U.S. economy did really well, the dollar ultimately went down. And in cryptocurrencies, they're doing really well. Bitcoin is at around $15,000 right now per coin. And last year it opened at around $700 per coin. That rate of return is quite ridiculous. It's insane. It's like 14,000% rate of return. That's pretty nice. And then ultimately, so gold also rose. Gold actually went up 15%, and the drop in the dollar has a lot to do with this. So something to watch out for. Gold is not really talked about too much nowadays, but gold did actually go up 15% and close at $13.0510 per ounce. And then as far as employment numbers, so on average we grew about 174,000 jobs per month in 2017. In 2016, we had 187,000 average per month in 2016. So employment has gone down a little bit, even though the unemployment rate has dropped from 4.6% in 2016 to 4.1% as of November 2017. So overall, there's less jobs out there, but also more and more people have jobs, if that makes sense. But remember, with tax reform and all these things going that are already out today, I believe that the labor market is going to improve and more jobs are going to be out there. And so according to the Bureau of Labor Statistics, there are about 6.6 million people unemployed in November 2017, down from 7.4 million in November of 2016. So overall, we're still doing pretty good. This is actually pretty big. So economic growth as measured by gross domestic product expended throughout the year increased at an annual rate of 3.2%, higher than inflation. So GDP grew higher than inflation, which is pretty good news. And so overall, that's pretty good. Inflationary trends did not keep up, as I was saying, with the economic growth in 2017. Inflation, as it relates to the consumer, remained below the Federal Reserve's stated target rate of 2%. And indicators that inflation is expanding, albeit at a deliberate pace. So, and then let's talk about housing. So let's talk about real estate. This is my favorite industry. So the housing market had been relatively strong for much of the year, although a lack of inventory may have impacted sales and prices. So right now it's a seller's market. There's not as much inventory out there as there used to be. And so if you own a home, if you own a property today, you have a lot of you have a lot of bargaining power with your prices. If you put a home on the market, it's going to go just like this, because ultimately there's less inventory. Now, if you're a savvy investor, you know there's always going to be inventory. So there's just something to keep in mind. These are more so public inventory figures. Investors usually find other ways to find houses, such as knocking on the doors of sellers and different things like that. And then, so through November, existing home sales are up 3.8% over a year ago. November annual sales rate of 5.81 million is the highest since December of 2006, before the recession. That's pretty good news. The median existing home sales price for all home types in November of 2017 was $248,900, up 5.8% from last year of $234,400. So home prices have gone up 6% as they historically have. And inventory, of course, was down 10% compared to last year. So overall, there's less inventory out there. And then, so there's expected to be an increase in mortgage rates in 2008, which could cut the affordability of new homes in many markets if inventory remains low. So overall, inventory is pretty low, and ultimately people aren't buying as many homes as they used to in the past. And then we'll skip all the way down. So on the year ahead. So the 2018 is off to a rousing start. I mean, we're off to a really nice start with the passage of the major tax overall legislation that will impact consumer and business income and equities. U.S. economy, which got off to a slow start in 2017, picked up steam throughout the year and enters 2018 in pretty good shape. I mean, we're in really good shape right now. And the Federal Reserve has indicated that it expects to raise interest rates 3 times this year, despite stubborn inflationary expansion. So even though inflation is less than expected, we still expect to increase interest rates over the year. The housing market should continue to grow, especially if builders pick up the pace of new residential construction to add to the dwindling inventory. So even though we have low inventory, there's new construction all over the place. So that's going to improve the inventory numbers. However, political unrest continues to plague Washington. I mean, when has it never? With the cloud of the Russian investigation hanging overhead as we begin 2018. So even though we have a few negatives going on with our government, that's always going to happen. Overall, we're still doing pretty good. Overall, the market in 2017 did really, really well. It's the absolute best year that I've ever witnessed ever since I've gotten into the market back in 2013. I've never seen a market do so well. Everything is up. Home prices are up. Stocks are up. Cryptocurrency is up. Everything pretty much, with the exception of bonds, are pretty much up at this point. So my advice to everyone listening is that if you're not an investor, or if you don't own stocks, or if you haven't invested or anything like that, just go out, just invest. First thing you do, go to Investopedia.com. Research whatever investment you want, whether it's a stock, whether it's a bond, whether it's an exchange-traded fund or ETF, whether it's an IRA or individual retirement account, or a health savings account, or an HSA. All of these things, the first thing you want to do is you research it. I don't mean spend months on it. Just a quick, say 15, 30-minute search, what is a stock? You find out what a stock is, and then you ultimately learn how to, you read a little deeper into it. Once you feel comfortable, what you do is you practice. So just like you learn anything new, you learn a new skill, you practice it. So you do virtual trading. They have virtual trading apps, TD Ameritrade, Thinkorswim. You have a lot of these different virtual trading apps. As a matter of fact, if you need one, I have access to a private virtual trading platform. I can set up an account for you. And so what you do is you practice, you virtually trade for a little bit, just a little bit, maybe a month. Now, if you're going to do this for the long term, then you don't really need virtual trading. Maybe a few weeks just to get your foot in the door a little bit. But you practice, and then you jump in, you dive, you go right in, because I would hate for anyone to miss out on 25% returns. And I expect us to be higher than even 25% this year. So that's pretty much it for the segment. I definitely thank everyone for tuning in. Key points: please go out and invest. Go out and let your money make some more money, because as Warren Buffett said, if we don't know how to make money in our sleep, if we do not know how to make money in our sleep, we will be working for the rest of our lives. So that's really for the segment. Thank you all for tuning in to WGHC 98.3 FM, your voice, your music, your station. My name is Jeff Badu once again. I look forward to a successful tax season, a successful stock market, a successful year, And I wish you all a fabulous
Don't
2018.
forget, if they file, you tell them if they file
Oh, yeah.
the code.
Yeah, so pretty much, yeah, if you file your tax return and you mention WGHC, pretty much what I can do is I can either donate 10% of the proceeds to the station, or I can use it as a discount pretty much for the tax return. So either way, it's going to benefit. Thank you.
I know,